is Jim Bullard. Many of you remember Jim came a few years ago when he was president of the Federal Reserve Bank of St. Louis. He is now the dean of the School of Business at Purdue. Hopefully this time he can be a little more candid about what he thinks the Fed is going to do, because they're not when they're working at the Fed. Anyway, please welcome back Jim Bullard.
Thank you, Peter, and thanks everyone for being here today. I'm looking forward to a rousing session. This is going to be more on tariffs because it's the topic of the day, but mine's a little bit more about Fed policy, interest rates, the dollar, and other aspects that I want to touch on here. So this is definitely Jim's view of what's going on. We'll talk a little bit about initial conditions. I do think it's important to keep in mind that coming in, things looked pretty good, so I'll talk a few slides about that. You've got these tariff threats that George talked about a little bit. I've got a little bit on that. I've got the game theory aspect. I've given this elsewhere, and the students love the game theory, so we'll talk about that. And the Jerry Maguire problem. That could be looming here. If you don't recall, Jerry Maguire, he was a sports agent. It's a movie from the 90s. You guys know that. It's California. He was a sports agent, and I forgot what happened. He either got fired or something, and then they're splitting up from the firm. But the firm is scrambling to get his athletes, and he's scrambling to get the athletes. And in the end, he gets only one, but as I recall, the best athlete. So there is a Jerry Maguire problem here that could develop on the decoupling side, so I'll try to cover that a little bit. There's a last trade war, which was 2018-2019. I was on the Open Market Committee at that time, so I lived through that one. A little bit about the dollar, a little bit about interest rates. These initial conditions are good. So I just wanted to illustrate that coming into this year, after the election, these numbers here in the middle of this page are the ones that were projected for the end of 2025 by the Open Market Committee. So the point of these is that these are very benign numbers. 2.1% growth would be very close to the potential growth rate of the U.S. economy. Inflation at 2.5% would be a little bit high, but it's been coming down. And unemployment at 4.3% would be very close to what many people think is the natural rate of unemployment. So this is about as steady state as it would get for the U.S. economy. That was the projection as of December of 2024, so coming into the year. And other real-time indicators about the economy, including about inflation, aren't really showing much of a ripple so far. So I'm going to show you three charts to make this argument that the initial conditions are good, and that means that whatever the trade war does, you could be coming in on a rocky path or something, and then the trade war is just enough to throw you into recession. I don't think that's where we are. You came in on a really good path, so you've got some room to maneuver. Here's a chart about from the Daily Shot, which is about the unemployment rate. This is a way to control for the seasonality. Those brightly colored lines are all the different years. The blue line is this year. So this year basically looks like all the other years that were successful years. The lines that go off the chart were 2020, the pandemic, and 2021 as unemployment came back down. So this is weekly unemployment insurance claims are often considered one of the best real-time indicators of what's going on. You don't see anything here, and this goes through last week. So far, so good. This is the GDP number that came in. Some of you may recall the GDP number was negative. That doesn't sound very good. Negative 0.3% growth. That's the dotted line in this picture. That's why that looks like it's tanking. So if you just looked at that all by itself, you'd say, oh my God, I guess the world really is coming to an end. But no, that's not what's going on. As George was talking about, there's a lot of front running because everyone hears the news, and one of the most interesting things about macroeconomics, and the reason why it's harder than physics, is that your particles have a mind of their own. And these particles definitely had a mind of their own. They saw the tariffs coming and said, I'm going to front run that, and I'm going to import a lot of stuff before it gets taxed. So the way that shows up in this data, that should have shown up as inventory buildup in the US, but it doesn't quite work that way, and so that dotted line went negative. But Wall Street wasn't too worried about this. That horizontal dotted line there shows 3% growth. This is from MRB Partners via the Daily Shot. And so the story is that if you just look at consumption growth and investment growth in the US and forget about the inventory part and the trade part, you get 3% growth. So a lot of times that's considered sort of a better measure of what's fundamentally going on in the economy, and that's a good number. So again, good initial conditions for the US economy. And a lot of people have said, well, the tariffs are going to raise inflation, but the market doesn't think that. The market thinks this. In this picture, this goes back to 2021 and goes across all the way out to the current number. This should be daily data, actually. It might be weekly data, weekly averages. This is the TIPS expected inflation rate. So this is actual people on Wall Street betting on what they need to be compensated for the inflation that might be out there in the future. And the break even is about 2.4% over there on the right-hand side. And you can see that this has not skyrocketed. Nothing's happened so far. So far, so good. Markets are not expecting a lot of inflation. So obviously, the incoming administration campaign on leveling the international playing field with respect to trade, but everyone knew that. But nevertheless, when you got to April 2nd, the announcement surprised everybody. It surprised Wall Street. It alarmed everybody. You could say, well, that's a negotiating tactic. You take an extreme position at the beginning and then see what you can get as you negotiate going forward. But these were at levels not seen since the early 20th century, so Wall Street didn't like that. Equity markets sold off, much to many people in this room probably were very familiar with that, and recession probabilities moved sharply higher. So let's look at those pictures. This is similar to the one George had. This is from Capital Economics via the Daily Shot. This goes back to 1890. This chart made the rounds pretty quickly after April 2nd. So as George was saying, tariffs used to be high. 1890 is the McKinley era, President McKinley, for those of you that are not recalling your US presidential history. And then that peak there around 1930 is Smoot-Hawley. I'm going to talk about Smoot-Hawley here in just a minute, considered a contributor to the Great Depression. And these, this is an effective tariff rate, that looks higher than Smoot-Hawley. Wow. So Wall Street didn't like that and sold off abruptly. Here's the recession probability on Kalshi as of April 22nd. This number has come down in more recent data, but this just shows you how much this went up in response to the announced tariffs. 60% chance of recession in the next year, shockingly high. I will say something, though, about this chart. Recession probabilities are kind of high on the left-hand part of this chart. So on the left-hand part of this chart, that goes back to August of last year. You might recall there's a bit of a recession scare in August, September of last year based on some weak labor market data. And this same measure had the recession probability between 40 and 50%. This is a betting market, so this is a daily betting market. If you want to bet on it, you can do so. And this came way down after the election and into the first of the year, as mostly because the data was way better. Some of the data got revised, and people weren't sure what the trade policy was going to be. But as that became clear that we're going to get a lot of announcements on trade, this certainly climbed precipitously. So here's the game theory. So let me just talk through this for a minute. The U.S. is on the role player, and they can play low, the L, which would be low tariffs, or they can play high, high tariffs. And the rest of the world is ROW, and they're the column player here, and they can play low or high tariffs. So the Trump administration thinks that we are in the upper right box there where it says current state benefits rest of world. That's what they think. So they think the U.S. is playing low tariff and the rest of the world is playing high tariff. And especially if you consider non-tariff barriers to trade, I think most economists would probably agree with that assessment. A typical country around the world doesn't really like the idea that they're going to compete with big American corporations who are very efficient. They ask for protection from their government, and they might get it directly in terms of tariffs. They might get it indirectly in terms of bureaucratic blockage of trade with the U.S. So that's the current state. Whether it really benefits the rest of the world is a great topic for a lecture. I'm not going to go into that, but it's perceived as benefiting the rest of the world. The low box there on the upper left is free trade. You could probably never have totally free trade, but free-ish trade, and that would benefit everybody. There's nothing wrong with the free trade theorems. You're better off allowing all the trades to occur that people want to occur. So that's where the free trade theorems would come in. The lower right is both sides playing high tariffs, so that would be like Smoot-Hawley. So just let me refresh you about Smoot-Hawley. In 1930, the Congress started, in 1929, there's a famous stock market crash. There was a rally after that, now called the Fool's Rally. And then in the first half of 1930, the Congress started talking about putting tariffs on at a high level, and they eventually passed that bill and sent it to then President Hoover's desk, and he signed it. And that's one of the suspects about what caused the Great Depression. There are others. Milton Friedman said it was the Fed. Of course, I don't like to blame the Fed, so I think Smoot-Hawley is a better thing to worry about, but everyone would say this is a problem. And the other countries, in that case, the other countries looked at that and they said, okay, we'll raise our tariffs too. So you just got, everyone went up, and all the trade basically dwindled down to very low levels or even to zero. So that's the Smoot-Hawley outcome. So what Wall Street was worried about was that you might get that kind of outcome. You might get, other countries just say, look, we just can't work with the U.S. anymore. We're just going to put up high trade barriers, and we're going to look for our, markets for our goods elsewhere, and that's going to be the end of it. So if that was the end of it, you would get trade collapsing, especially with the prohibitive tariffs that you're looking at between China and the U.S. And if you had that, then that would be a very bad outcome that would damage the value of the equities being traded on U.S. markets, and you'd have a global recession. This is where the Jerry Maguire problem comes in. A version of this is that it's China and the U.S., and if China and the U.S. just leave their tariffs very high, all the other countries will be scrambling, just like they were in the Jerry Maguire movie. They'll be scrambling to decide which side they want to associate with and create a deal that way. And so there's some of that going on if you read about it in the papers. My experience in reading and thinking about the Cold War was that you had a very similar thing going on. You had the Soviet Union and the United States Many of the other countries were very shrewd about trading off the Soviet Union against the United States. They wanted to see, well, what are you going to give me if I join your side? And you get that kind of competition going on. So I call that the Jerry Maguire problem. There was a trade war in 2018, 2019. It was a war of words between China and the U.S. It drove higher uncertainty, and I've consistently told audiences it's that which can send you into recession. No one wants to make $1 billion investment in some country if they don't know what the trade rules are going to be. So in corporate boards all across America and all across the world, and some of you are on them, they're all sitting there saying, why don't we hold off on our $1 billion investment until we find out what the rules are going to be? So you have this pulling back. That's a very clear dynamic that's going on. And in 2018, 2019, that eventually slowed down the U.S. economy in the summer of 2019, and the Fed responded to that by lowering the policy rate. So you could get that dynamic today. I would stress, I lived through it. Inflation was below target at the time. We might have welcomed a little bit of inflation at the time to get up closer to the target. We didn't really get that. By our preferred measure, inflation actually declined in the first half of 2019 as this trade war was going on. So I think the inflation part of this story that's dominating in the media, it has to be reconciled with what's going on here. This time you do have threatened tariffs, which are much higher than they were in 2018, 2019. A lot of people tell me that the dollar is going to lose its reserve currency status. That's because the dollar has depreciated recently. This has bounced up just a little bit here at the end of this chart. This chart goes back to 2022. And I think you might interpret that as a squiggly line. That would be the scientific term for that. But the point is, yeah, you've depreciated a lot in 2025 here. That's about 8%. When this chart was drawn, this is a trade-weighted value of the dollar. But you see movements like that since 2022, 2023, 2024. So it's not enough yet anyway. It's not enough, nowhere near enough to say, oh, all of a sudden no one wants to hold the dollar globally. I don't think so. So you got a ways to go if you want to make that argument here. If you go back further, the dollar was actually weaker. So you'd have to go quite a bit lower just to get to levels that you might have seen pre-pandemic. And then the last point here is on rates. What are rates going to do? That's the classic question. And I just wanted to make this point with this chart. So this is a yield curve chart. So we'll take the 30-year Treasury yield and we'll subtract off the 2-year Treasury yield. The 2 years, at the short end of the curve, more related to Federal Reserve policy. The 30 years, the long bond yield. If those are inverted, that's usually a recession signal. So if we subtract one from the other and get a negative number, that would be a recession signal. And we had that here in 2023, according to this chart. Over on the right-hand side, which is 2025, excuse me, this has actually been going up. So what the heck is going on? If this is a recession indicator, and it's a powerful and very accurate recession indicator, then why are the Kelshi guys buying that in that probability chart? They were all saying there's 60% probability of recession. This is saying there's not much probability of recession. So, and the other thing about this chart is that this period here in the, oh, I can't do that, huh? Okay, I'll do this. In 2023, that period, this thing's negative. Why is that? That's because the Fed raised rates enormously in the second half of 2022. That was the time we did 475 basis point increases in a row. I was a big advocate of that. And markets thought we were going to have a recession. I said we weren't going to have a recession, but markets thought we were going to have a recession, and so this was inverted all through that period, all through 2023, and only reluctantly went positive in 2024. But why is this over on the right? Now everybody kind of thinks we're at higher recession risk now. Why is this thing going up? Well, maybe something else is going on that's making the longer-term rates go up, and the something else is a debate in Congress over U.S. fiscal policy, and they have to decide between, and they're obviously going to try to pass the bill here. They're trying to decide what the level of taxation should be, what the level of spending should be, and what the level of borrowing should be. And I think, and my reading of it is, they don't really want to change the taxes, which means keep the old tax cuts in place. And they don't really want to change the spending either, which sounds like you're going to borrow a lot of money going forward. So the Committee for a Responsible Budget says that you're going to send the U.S. debt to GDP ratio at 150%. It's depending on how you measure it, it's 100% today or 120% today. So it's got, markets might be reacting to that and might be saying, well, if that's what you're going to do, then I'm going to demand more of a risk premium for longer-term lending to the U.S. government. So that's one interpretation of this story. Okay, let's finish up. I said that, just so you don't forget what I said, because I don't like that, so don't forget what I said. So initial conditions are good. That gives us some cushion. So that's probably good news. That might keep us out of recession. The threatened tariffs were definitely higher than expected and at Smoot-Hawley type levels. So that's pretty high. We've got this game theory going on between the rest of the world and the U.S. and bilaterally between all these countries. It's not clear how that's going to play out. There's this decoupling risk between China and the U.S. One way to think of that decoupling is that you are going to get some decoupling. I mean, the Treasury Secretary even said today, for some goods, we're not going to be trading with China. So you get some decoupling, but how broad would that be, and how much does that set up a Jerry Maguire problem? The trade war in 2018-2019 gives you a roadmap. You did get deals made. Inflation didn't really take off. Growth was slower, and the policy rate moved down. So that might be what happens this time, but this is a bigger trade war than what we had at that time. And finally, longer-term yields today could be pricing in U.S. fiscal situation more than in the past. So thanks. You've been a great audience, and I look forward to seeing many of you later.
One question. Okay, so you mentioned that they did cut rates in 2019. You were there doing that. You just mentioned that this is bigger. What's your expectation for what you think the Fed is thinking right now and where they might go?
I think the Fed's in great position today because they already lowered 100 basis points in the second half of last year. That brought rates down to a lower level. You still got inflation a little above target, so you can leave the policy rate where it is, see what happens. And then from there, they've got some possible rate decreases in the future. That's pretty good for markets. So that's a pretty good place to be.
Okay, great. Well, thank you, Jim.
All right, thanks a lot.